Firstly, make sure I welcome everyone and thank you for attending today. Today's session should be really interesting. We're looking forward to hearing from Marcus Bogdan, who's our Australian equity specialist, but also we've got other participants on the call today or the webinar today, being Mark, Cam and Guy, who all sit on the investment committee. It's been a really interesting, start, middle and towards the end of reporting season. And it's really important at this point of the year for us to take stock and give you some feedback as to how we feel that reporting season is going, and importantly take that information to help reposition portfolios for FY22. So really looking forward to hearing what Marcus's key observations are, some thoughts around valuation, and then obviously looking forward to hearing from you and any questions that you might very well have. So just a reminder, my name is Simon Matter. I'm the Managing Director of Prime, and I'll be the moderator for today. So please, any questions that you've got, you'll see that tab at the bottom of the Zoom call where you can just type away until your heart's content and ask us lots of difficult questions, which we look forward to answering. So please do that during the course of the presentation, and we'll have 10 or 15 minutes of questions at the end. So again, sincere apologies for running a little bit late. What you just saw on screen a second ago is the important disclaimer. This is clearly not personal advice that we're providing right now. It's going to be essential that you speak to your advisor as to how we take some of this information and apply that to your portfolio. And in terms of our agenda today, I think I've touched on a little bit of this, but firstly, the key observations will be where we start, where Marcus kicks off. We'll then go through the company results on a sector basis, and you can see there we've got banks, healthcare, industrials, etc. We'll then talk to you about some of the portfolio changes that we've already made, the logic and philosophy behind that. And then we'll start looking forward to FY22 and what is obviously a very interesting environment given what is happening with COVID. And we want to start to think about the impacts we think that might have on the portfolio. So lots of interesting things to cover off. I'm going to pause here. I'm going to hand to my colleague Marcus to kick us off. And again, thank you very much for attending today. Over to you, please, Marcus.
Well, thank you very much, Simon, and thank you very much for your interest today in a most remarkable period that we're seeing in equity markets and the broader economy. Today, I'd really like to go through four things. First is provide an overview of my observations of reporting season so far for the 2021 reporting season. Then we'll do some more granular analysis around industry trends and company analysis on some of the key portfolio stocks that we have. And then thirdly, to talk through some of the changes that we've made at a portfolio level through the reporting season. And then finally, providing some concluding remarks, some illustrations of portfolio composition and how we really are positioned for 2022. So if we turn to the reporting season in 2021, the expectations coming into the reporting season was particularly high. Expectations of earnings growth of between 25 and 28%, which is a remarkable recovery in earnings, given that in 2020 we had a contraction of around 20%. Markets have been extremely strong. Year to date, the Australian share market is up over 20%, but that's been based on structural and fundamentally sound recovery in earnings. And as I've said, we've seen that one-to-one relationship of a step up in Australian earnings of well over 20% and an uplift in dividends as well. So that's been the underpinning of the markets, coupled with the fact that monetary and fiscal conditions have been very accommodative, and that we've got interest rates at record lows. So the combination of record low interest rates and earnings growth has been the catalyst that has driven these markets higher. And in the first week of the reporting season, we certainly did see very strong and encouraging results, particularly from the banking and the insurance sectors and from the material sectors. The key hallmarks that we saw there was strong earnings growth, strong recovery in dividends, the initiation of buybacks, the initiation of special dividends, and some earnings upgrades as well. As we've moved further into the earnings season, there has been a far more cautious approach by Australian corporates. And we're seeing those Australian companies that are facing into the large Australian domestic markets of New South Wales and Victoria, seeing that operating conditions have tightened. And where expectations were high in early July, those expectations have moderated. And we've seen this quantitatively in terms of the number of upgrades and the number of downgrades. In the first couple of weeks of the reporting season, we saw more upgrades than downgrades. What we're starting to see in the last couple of weeks are greater downgrades and a stalling of the number of upgrades that we've seen in the market, and a more circumspect view in terms of guidance and outlook. And what we're seeing here, and if we go to the next slide, is that financials have delivered very strong results. And so if we break down the 25% earnings per share growth that we're seeing in the Australian market, it's been really been delivered by two sectors, namely financials driven by the banks, and in the key commodity companies such as BHP. We are seeing a more muted upgrading cycle in the industrial space. And I think if we turn to the next slide, it's illustrative of what we're starting to see in the real economy. We are seeing operating costs rise. We are seeing pressures in supply chains, both domestically and globally. And the cost of delivering goods into markets has risen quite significantly. We are seeing pressures in transport, the delivery of raw materials, and the rising prices of raw materials as well. And that is starting to have an impact on margins for businesses. It has been pronounced in the industrial space, and whilst we're seeing very strong prices in the commodity sector, we are starting to see a rise in costs. So that's a sort of a high level view of what we're seeing broadly from reporting season. A very strong report card for 2021. But as we go into 2022, those companies that are facing into the domestic market are starting to see some moderation in growth expectations. If we turn to the sector analysis, and particularly on the companies that are key components of our portfolio, I think it would be useful if we just go through some of those examples to illustrate the reasons why we have those companies in the portfolio and what they are actually seeing on the ground. As I've said, the banking results have been strong. Commonwealth Bank is a June balance date company, and that delivered earnings per share growth of around 17% and a dividend growth of around 17%. It has an unquestionably strong balance sheet, which has allowed it to initiate a $6 billion buyback. We expect to see further buybacks over the next 18 months or so. And Commonwealth Bank is Australia's largest retail bank, but it has been leading in both above system growth in mortgages and in business lending. And it has the strongest deposit book as well. So the premium that Commonwealth Bank does trade to the other three retail banks is justified given its above system growth and its strength that it has in its balance sheet, and it is facing into the mortgage market, which is where we want to be tilted in the banking system. The next area I'd like to touch on is in healthcare. CSL has been one of the bedrock companies in the portfolio. It has a strong history of earnings delivery and being able to deliver earnings growth through the cycle of around 10% per annum. It is a global leader in both plasma therapies and in vaccine delivery. And it delivered a result for FY21, which was above market expectations, where it delivered EPS growth of 10% and a 10% uplift in dividends. FY22 was always going to be a more challenging year, a transition year for CSL, as it has been impacted by what it's in its largest market in the Northern Hemisphere, where there have been constraints around the supply and the collection of human plasma in that market. And that supply has been contracted by around 20%, whilst the underlying demand for those plasma therapies continues to be strong. The full effect of that is going to be influenced in the 2022 year. The market is currently looking through 2022 because there is a strong expectation that you will see a full recovery in 2023, where the drivers of demand of plasma are undiminished. And what we have started to see in the last 6 months has been an improvement in supply by CSL adding on further collection centres in the US, drawing down in inventories and being able to put up prices as well. And so we expect to see a full recovery in their business in FY23. The other part of their business is in flu vaccinations, and that has delivered a particularly strong result, both not only in revenue, but also in earnings growth and margin expansion. The flu vaccination, like the COVID vaccination, is protection to respiratory disease. And so the demand for flu vaccinations, particularly in the Northern Hemisphere for 2021, was at record levels. And the expectation is that demand will certainly be the case in the upcoming winter months for their largest markets, being both in the United States and the US. And they are a global leader in that. And so CSL remains a core component of the portfolio. If we turn to the next slide, we'll look at some of the more sort of defensive industrial companies that we have in the portfolio, namely in Brambles and Cleanaway. Brambles delivered a strong result. It was at the top end of guidance, and it delivered strong growth, not only in revenue, but also in earnings. And it was even through incredibly challenging supply chain issues there, particularly in their largest market in the United States. They were able to deliver EBIT margin expansion. They have deferred guidance until their investor day in September, and so we'll await to see how FY22 stands, but we'll come back to Brambles later in my commentary. The second company is Australia's largest waste management company, Cleanaway Waste Management, which delivered a solid set of results for 2021. It had sales growth of around 4%, and EBIT and earnings growth of around 3.88%. But a very nice uplift in the dividend of around 12%. At this stage, unwilling to provide earnings guidance, given what we're seeing in the lockdowns that we're seeing in New South Wales and in Victoria. And whilst residential waste volumes are holding up very well, there has been a contraction in SMA volumes, which is expected, as many of these businesses that they collect waste from have been effectively shut down. Another area of weakness they're seeing is in their deposit scheme. They run the container deposit scheme in New South Wales, which is the collection of plastic, aluminium and glass bottles. That has been suspended for the moment, but that scheme will recommence once they come out of lockdown. And so they are certainly expecting a more moderate year in terms of earnings for 2022. We still remain incredibly positively orientated towards Cleanaway, because they have acquired assets from sewers in terms of landfill and transfer stations, and they are building very important infrastructure around renewables and the treatment of waste in the Australian market. And so it is not only an essential industry, but it's also building out a very important footprint in terms of infrastructure. If we turn to the materials sector, the results delivered by the key resource companies in Australia have been unquestionably strong. BHP delivered EBIT growth, earnings growth of around 69%, which was in line with expectation. Dividend growth of over 151% was ahead of market expectations. And BHP has been a beneficiary of such strong iron ore prices and copper prices. They didn't make two key announcements in their result. One was the spin-off of their petroleum assets and the potential merger with Woodside and an in-specie distribution for BHP shareholders. And the second thing was the collapsing of their dual listing structure of their UK listing there as well. But BHP remains in a very strong operational position, delivering record free cash flow earnings, and also well positioned to continue to pay very attractive dividends to investors with an extremely strong balance sheet. If we turn to the next slide, media and telecommunications has had a very good set of results. News Corporation is one of our largest active weights in the portfolio. The largest component of that business is digital real estate. They own 60% of REA, which is the online portal in Australia. And then they own 80% of the second largest digital real estate company in the United States. Both of those companies have delivered very strong results, and it's been notable of a very strong recovery that we're seeing in their Realtor business, which is their digital real estate business in the United States, which has been taking market share growth there and has been a remarkably strong recovery play. The second element where they've been able to drive very, very strong growth has been in Dow Jones, which owns a range of flagship media brands, such as the Wall Street Journal, which is benefiting from the digitalisation and the subscription model in that business as well. If I combine both Telstra and Spark, Spark is the largest telecommunications company in New Zealand. Both of those companies have started to see a recovery in their mobile markets. Both will be beneficiaries of our move from 4G to 5G. They both pay very attractive dividends and sustainable dividends to shareholders. And so that both plays an important part in the portfolio as well. If we turn to the next slide, I'd like to just touch on some of the portfolio changes that we've made in the portfolio recently. We initiated a position in Marley Spoon, which is in a small emerging company in food delivery. What we have seen, particularly through COVID, has been a strong uplift in the interest in online food delivery. We've seen that in the supermarkets and the 100% growth that we've seen in Woolworths online business. And we're seeing it in these smaller players, which are providing meal kits to households with recipes as well. Marley Spoon is a global company. It has operations in the United States, Europe, in Australia, and importantly, it has a five-year agreement with Woolworths, where they're sharing supplies, logistics, and the customer base to market to. It is a very large addressable market. There are only really two true global players globally, both Hellofresh and Marley Spoon. And we expect that this company can grow between 30 and 35% over the forecast period. The second area that we've made, we have reduced Brambles in the portfolio. Whilst we do like the fundamental business of Brambles, its position globally, it has had a particularly strong 6 months where the share price has grown by over 20%, and it is up at the upper end of our valuation. And so we've just reduced that and we've put that money to work in Marley Spoon. The other changes that we've made recently, we have added to Goodman Group, which is one of the world's largest logistical warehousing groups, major customers such as Amazon. It has been able to grow at double digits, and the expectation over the forward years is for continually strong growth. And then finally, we have reduced a very large overweight position in Helios, which is the second largest provider of pathology services in the Australian market. It has been a huge beneficiary of COVID PCR testing. We think that a lot of that is already in the price. And whilst we are very supportive of the underlying business, we felt that the recent strength that we've seen in that position allowed us to take some moderate profits there. And we have built up our cash position. And so if we turn to our final slide, is really the outlook for 2022 and how the portfolio is positioned. At the start of this reporting season, expectations was for earnings per share growth of around 11%. Still very good growth, still well above trend. What we are seeing is that we've got companies that have got particularly strong balance sheets. There is a tendency to be shareholder friendly in terms of initiating buybacks and special dividends where they are. But what we have seen in the last couple of weeks has been a moderation of expectations and outlook. And that has been evident in what we're seeing in terms of the contraction that we're seeing in some of those markets. Cleanaway have notified what they're seeing in the New South Wales market. And then Ampol is another company that has seen a 15 to 18% contraction in fuel volumes and a 15% and 18% contraction in convenience store sales as well. So that trend is emerging. And so that really suggests that the tilt in the portfolio still needs to be in those companies that are well positioned with resilient earnings. Companies such as Endeavour Group, which was the spin out of Woolworths, which is the Dan Murphy and BWS brands, which continues to deliver very strong results. Our position in consumer staples through Woolworths and Wesfarmers, Goodman Group in terms of online warehousing and delivery, and also in Helios. Whilst we've trimmed that position, it still remains a strong position in the portfolio. But we do need also to have eyes on the recovery. And there is a pathway out of lockdowns, which has been articulated by the Doherty Institute and by the government, if we can get to 70 to 80% vaccination rates for those eligible for vaccines. We have seen a very good recovery in some of those Northern Hemisphere markets, which are ahead in terms of vaccination rates and the reopening of those economies. And so we fundamentally want to be in what we believe are long-term strong companies that are industry leaders that will recover. Companies like Cleanaway, CSL and Ramsay are those core component companies. But the tilt in the short to medium term is definitely those companies that are what we would construe as essential industries, market leaders with strong balance sheets. Simon, I might pause there for any observations from other Prime members or other guests that we have on this call.
Yeah, fantastic. Thank you, Marcus. That was great and obviously very informative. And we've got our first question, which is also great. So we've got our first question from Philip saying, how will China reducing consumption of Australian iron ore affect the market? So we might give that one to you, Marcus.
Yeah, no, sure. And, you know, we've been very keen observers of Australia's terms of trade to China. And whilst we've seen a large pullback in certain areas around agriculture and thermal coal and other goods, what has underpinned our terms of trade, our budget, has been the continued delivery, particularly of iron ore and copper in those markets, and where you've seen those prices at very elevated levels of over $200 per tonne. There have been supply constraints. You've seen that in Rio's guidance, and you've seen continued supply constraints from the other key contributor being in South America. What we've seen in recent weeks has been a pullback in the iron ore price. Now, this was always going to be expected. Treasury had $55 in their budget papers in terms of their medium to long-term view on the iron ore price. You've seen it in the budget papers in WA of around $95. You've seen a 30% odd pullback in iron ore prices, and that's been driven by a slowdown and particularly in the steel mills in China. This is seasonal. The expectation is that the peak of that slowdown will occur in August. There is no doubt that China has a policy of diversification, and that's what they're seeing is that they want to have multiple participants supplying their markets globally, and you've seen them pivot away from other commodity and other products in the Australian market. But iron ore, there are only a number of players to date that can supply that market, and particularly in such critical areas of infrastructure and property. So we are seeing a noticeable slowdown in both in the Chinese steel market. The calls that we've been on most recently expect that will sort of peak in the August and in September, and then in the coming months that there'll be a continued uplift as China comes out of lockdowns, and also the slowdown that they're seeing in the steel market. And that BHP still makes an incredible profit margin, even with iron ore prices at $140 or $150. And the consensus is around that the iron ore price will moderate around those levels, but then longer term will even moderate even further to be around between $80 and $100. But at that sort of rate, BHP still makes a very good margin on that.
Makes complete sense. Thank you. Got another question here from Paul. So he's intrigued by the Marley Spoon recommendation, and the question really is, when do you expect it to be profitable? And the statement is also that Hellofresh is a potentially better offering and still not profitable. That's Paul's understanding. Can you just talk to any of that in terms of the dynamics there, and obviously with the growth rates at sort of 30%?
Yeah, sure. I might just touch on the sort of the underlying philosophy that we have, where through the history of the portfolio, we have had small positions in emerging companies or disruptors, and the signposts and the guidelines we have of putting those companies in the portfolio is that they are disruptors in very large markets. They are industry leaders. They have a global footprint with very large addressable markets, with large subscriber bases, and very few true global competitors. We've done that through historically through Xero and Nearmap, both of companies that we took very strong profits in. And now we've shifted our attention to what we're seeing in online delivery of food, and that recovery that we're seeing in that business as well. You're absolutely right. Hellofresh is about 7 times larger than Marley Spoon, but they're only two true global providers of this service globally. In each of the markets, there are some individual competitors there. And those businesses are in growth mode. And so they are reinvesting back into those businesses ferociously to expand their footprint, to expand their distribution things. And so from a cash perspective, they are near cash break even in both instances, and they have very small losses there at an EBITDA level. But both businesses have shown a history of being able to grow between 30 and 40%. Hellofresh has been able to grow at a higher rate, particularly in the last 12 months, and they've had fewer disruptions than Marley Spoon. But our interest in Marley Spoon was the fact that those disruptions saw a third contraction in their share price, and we felt that significant pullback in that share price provided us an interesting time to initiate our position in that company, with the expectations that company will be able to grow at between 30 and 35% over the forecast period.
Excellent. Thank you, Marcus. Just a question from me. Is there any particular sort of company that surprised you through reporting season, either for better or for worse? Was there a real standout from your perspective?
It was encouraging to see companies like Commonwealth Bank, even as the market leader, to be able to grow above system across each of their key product lines. The other thing that we've been watching also is in companies that have been able to pass through the higher operating costs and the pressures that they're seeing in supply chains. And Brambles was certainly being able to deliver that through that period of time. So what we've seen is that those industry leaders have been able to demonstrate absolute leadership, and that has been encouraging. Okay.
And Paul's got another query here. Is there any weighting or consideration in the portfolio towards the growth in electric vehicles, i.e. lithium or similar?
Not directly in terms of direct investments in lithium or in electric vehicles. We do note the portfolio change and the tilt that we're seeing in BHP to those what we would describe as the green mineralisation, both in copper and nickel, and also the importance of steel production going forward, and their exit in the petroleum area. And we do participate in that through also in waste management through Cleanaway and that green infrastructure. And that is also part of the growth aspect in Macquarie Bank as being a global leader in future green energy and green infrastructure.
Yep, great. Philip's got another good question, just in terms of lessons from COVID and the pandemic. So Philip's just asked, what can we take away in terms of our investments? What are the positive and the negatives in terms of lessons learned during this period, during COVID? What are the key takeaways that you think about, sort of 18 months in terms of the portfolio?
The key observation I would make, and it is a pleasing one, that those industry leaders that we have in the portfolio have been able to adapt their business model. Two examples I would say would be in Woolworths and their ability to grow into online grocery and to be able to grow that by over 100% and really capture that market. And if we look at online penetration, the true laggard in online penetration historically has been the delivery of food, particularly in supermarkets. It's the largest area of retail, but it has the smallest footprint online. And that business has been able to adapt there. It's been an industry leader there. And so significantly, I think that actually puts them in a structurally strong position as they come out of COVID. And where they were in the trenches with companies like Aldi prior to COVID, Aldi has no online significant offering. And so Woolworths there is particularly ahead of the game. We have seen adaptation also in companies like CSL in their plasma therapy business, where those therapies, they've been able to adapt their product range to be able to deliver those products at home. So patients historically have gone into hospitals and clinics, but they've been able to deliver a mechanism where patients have been able to have these life-saving therapies delivered at home and to be able to deliver it themselves. And those are structural changes. They're higher margin businesses, and they also provide, very big drivers of their structural competitive position. And so that is definitely being encouraging changes that we've seen through COVID, and that adaptation there as well. And there are many other examples as well.
Yeah, it's fascinating, isn't it, how some businesses are able to adapt so quickly. We've got another good question here from Philip. Does the portfolio consider ethical investments as a criteria for investment? So I know, Marcus, you'll obviously have a view on that in terms of the way you've approached ESG generally, but we might also ask Cameron to make a comment later on once you've finished off.
Mm-hmm. Well, certainly environmental, social and governance issues have come into greater prominence over the COVID period. And one of the founding principles that we have in looking at the companies that we have in the portfolio is that we do look at industry leaders, and industry leaders are looking at a range of different filters, whether it's earnings quality, whether it's balance sheet strength, whether it's management execution. And we also want our companies to show true leadership across environmental, social and governance practices as well. And so that is a key filter that we have in our portfolios in the way that we look at those businesses. So we want them to show leadership in their key parts of their business, and we want to see that those trends over time are actually improving, that they are getting better in terms of protecting their workforce, in terms of having a more comprehensive, sustainable footprint in terms of their carbon output through their water practices, through the materials that they use, through their processes. And so for each of the companies that we look at it through those screens.
Yeah, look, it's obviously on the agenda for every company these days, isn't it? It's part of any talking point for any board to be considering their impact. Cam, is there anything else?
Yeah, and importantly, you can look at it both in a lens of negative screening and into also positive screening, and we want our companies to actually add value in those areas that actually strengthens their underlying competitive position into the future.
I'd throw in a couple of comments there as well, that the Prime Investment Committee have been spending a lot of time in the last few months formulating our preferred ESG friendly and consistent approach across each of the asset classes. So Marcus and on the Australian share front has got the policy well established, and as it is an integrated part of his delivery of his investment portfolio. We've been interested in coming up with a preferred listing of exposures across the defensive part of the portfolio, and then the international and alternatives as well, and just making sure that we have selected some top performing funds that are true to label. It's an evolving space that's evolving very quickly, and a lot of firms claim that it is very much integrated as part of their process, and maybe when you dig under or look under the hood, maybe it's not as integrated as one might suspect. So we've been trawling through a lot of investment offerings, both on the exchange traded funds and the managed funds, to have a broad, well thought through, considered approach to fulfill those requirements, and really trying to target both, as Marcus said, the negative screening of taking out sort of high polluters and people that might have some exposure to modern day slavery and the like, but then also having some positive filters on companies that are really promoting change and for the environment, but also the social and the governance side of things as well. So some funds are going to be very broad, and then there's some impact funds out there that will probably have a much smaller investment menu, but really try and be agitators for change a little bit more than a big broad fund. So mixing all of that up into a portfolio that makes sense is something that we're just putting the final touches on at Prime.
Thanks, Cameron. I think it's important, and we appreciate you taking a leadership role in this for the investment committee. So if people do have particular questions about that, happy to sort of forward them through to you, Cam, in the first instance. There is another question there from Phil, just in terms of climate change and affecting future investments. And this is a big topic and not a particularly easy one to probably answer, but it's for that reason we'll throw it to you, Marcus, to have your best crack at it. But how do you think about climate change and future investment strategies and the like?
Well, I think Macquarie Bank is an example that we've got in the portfolio where they are allocating capital towards green energy. They were early movers in that with the acquisition of the Green Investment Bank in the UK. The UK is definitely a global leader in green energy. And they're financing, owning, and being participants in the growth of green energy, and that will become a very significant asset class going forward. And we also, we talked about our ESG guidelines. We want our companies that are industry leaders to be actively involved in reducing waste, not only at the storefront, but also through their entire supply chains, and that is something that we look at and we measure. We've still got a long way. Australian corporates have still got a long way to go in that process, and it requires the participation of many players for that to occur as well. And we're seeing that in the expansion that we're seeing, particularly in companies like Cleanaway, in terms of recycle use, the joint ventures that they have with key packaging groups like Pact and providers such as Aurora as well.
Right. Thanks, Marcus. And probably just the last sort of question from me, just to round this out, given we're just at 12:01, but there's a bit of M&A activity that you're starting to see play out in the market. And one of the companies that has been in our portfolio, Spark Infrastructure, has had a takeover offer, I think, recommended by the board, for shareholders to take up. But do you see, Marcus, firstly, and then I might throw to you, Mark, because you know quite a bit about Spark Infrastructure, but do you see that being something that is going to continue to increase, in this market, or do you think that people will take a bit of a step back and a bit of a pause if they feel a bit more uncertain about the future? Do you have a view on the whole M&A lens as part of inorganic growth for some of these listed?
Yeah, I firmly believe that M&A will still remain very prominent in our market, in other markets as well. We've seen very large acquisitions made globally, and also very keen interest in the Australian market of international companies looking at companies like Afterpay, and where you've got interest rates at record lows, and potentially with slower economic growth, companies more and more will be looking to use M&A as a way of continuing to grow. And so I think that will be an absolute hallmark, and we've seen that over the last 12 months, and I think those trends will continue for the foreseeable future.
Thanks, Marcus. And Mark, do you just want to round out with any comments you've got on Spark Infrastructure, because you follow that pretty closely?
Yeah, sure. Look, Spark Infrastructure is a stock we've had in client portfolios more recently, over the last 12, 18 months. It's fair to say, going into the stock, we weren't buying it for that takeover eventuality. But as it turns out, investors in Spark Infrastructure are getting a nice premium. I think most of our clients are sort of in the stock at about $2, and obviously the takeover, all cash takeover, is $2.95, but that will be less any distributions paid by the company. So it's been a great result where you get somewhere between a 35 and a 50% increase on what we've paid. The challenge, of course, is that that was yielding 6% for clients, is just to replace that in portfolio, because acutely aware that a lot of our clients are trying to generate some income out of portfolios. But in terms of the actual process with Spark, it's probably not going to be until the new year until we have to deal with the proceeds. So whilst the directors have recommended the offer, it still needs to get past the Foreign Investment Review Board. But that, I think, given the consortium that have launched the bid, we think that's likely to get approval, and the documentation's out in December, with the deal sort of being wrapped up and proceeds paid out early in the new year.
All right. Well, thank you very much, Mark, and in fact, thank you everyone else. And just on that theme of yield, just probably keep an eye out. Cam and I are just doing a short video. I believe on Friday, we're just going to be covering off some of the yield-centric ideas and some of the things that we're considering around that front. So keep an eye out. We'll be distributing a video on that, hopefully over the course of the next sort of 3 to 5 days as well. But this has been great. Really appreciate everyone firstly attending, and obviously for all of our key speakers, and in particular Marcus, thank you for your time, your energy, your analysis. We know that this is a particularly busy time, and the last 2 or 3 days, I think there's been a whole host of companies reporting. So we appreciate your knowledge and your insights, and look forward to continuing to put that to play with the portfolios. And thank you again, Cam and Guy and Mark, for your participation. So please enjoy the rest of your day. We have taped this, so we will circulate for anyone that didn't get a chance to attend. And we look forward to speaking shortly. Thank you very much for your attendance.
Thank you.
Thanks.